Welcome to the latest episode of Alternative Litigation Strategies podcast. I'm your host, Kevin Skrzalski. I'm a director at the litigation consulting firm Certum Group, the industry's only provider of litigation finance, insurance, and other legal solutions. On this program, we discuss the latest litigation industry trends with the country's top experts, and today we're going to discuss M&A strategies for personal injury law firms, and I'm pleased to be joined by an expert in this field, Seth Deutsch. Seth is the founder of Samson Partners Group. He's a growth leader. He's an operating partner, a board member, a CEO with a track record of delivering profitable growth for private equity-backed, family-owned and public companies. Seth founded Samson Partners Group to help other founders and CEOs achieve their financial goals. Seth, it's a real privilege to have you on the program today. Welcome.
I'm so excited to be here. Go Bucks. Let's dive in, man. I'm excited.
Yeah, from one Ohio guy to another, go Bucks, and I may have a future alum who's striving hard to get in there next year. So,
I know some folks. So, let us know. My wife is an immigrant to the U.S. and came from Iran. And it's a long story about how they made it over to Ohio, but they started in California. None of them spoke a word of English. It was her brother, younger brother and sister, and their mom. Her father had to stay behind. And her mom had played mahjong with an expat from, it was either the Marathon Oil Company or Ashland Oil Company, I can't remember. And her mom was upset that the kids were repeating math and science that they had learned in Iran like a few years before. She felt the U.S. school systems were behind in math and science. And it's very Persian. And so she called her friend in the U.S., who was the only person she knew, and she said, come to Ohio. The school systems are different or better than California. And so that's how they made it to Ohio. And Nadia graduated from Ohio State. Her brother and sister did. We still have 4 season tickets, although we haven't lived in Columbus in 20 years. And about 3 years into our relationship, we've been together 25 years now. And I will paraphrase. She said this to me after a game because I was not recruited by Ohio State, so I had a little bit of a grudge. And she said something like, you will either start, she said, I'll make this easy for you. Either start rooting for Ohio State or find someone else to marry.
That's a hardcore Buckeye, but
that's a hardcore. Look, you got to respect.
Part of the course.
Respect.
Yeah. Anyways, Samson Partners. So I noticed in the beginning of 2026 that you made a couple of strategic hires to increase your advisory and your coaching services to law firms. So let's have you tell us a little bit about Samson Partners Group and what you do, and then particularly what you're offering through your legal services advisory vertical.
Yeah, Samson, I've had 5 exits in my career. Not always as a CEO, a number of those as a CEO, some where I was a part of the team. I've run very large and scaled professional services and blue collar services companies in my career. I've acquired myself as an operator over 80 founder-led businesses. And so I know what it means to do that. I know what it means to take them to get them to join you. I know what it takes to honor your commitment on the other side of a deal. The last platform that I built was in the finance and accounting space. Took the business from $1 million of profit to $30 million of profit organically and inorganically over 2.5 years. Did 12 acquisitions, integrated them hard, created cross-selling. We were growing at 30% a year organically. And all of the founders that trusted me to join me, we returned on the second bite of the apple a 6.5 times return on their rollover equity. It's really hard to do in professional services. And this was all post-financial crisis, but this is when things got real, right? So on the heels of that, I decided to return to my roots as a basketball coach who became a CEO who decided to return to coaching. And having spent so much time on the private equity side, but as an outsider who was kind of like the hired gun to come do these things, I had also, in the 80 acquisitions that I did, I'd probably looked at 3,000 companies. And I remember a particular experience. I'm the chairman of a restoration company. And I remember a particular experience a few years ago where a family that kind of grew up like I did with not much money and scrapped it together. Husband and wife team, 4 young kids, small restoration business in Kansas City, and they were doing about 400,000 of net income, and that's incredible that they could come from a trailer park and do that.
It is.
And
Yeah.
and a business broker had gotten them to list their business for sale, and the business was completely untransactable. They basically had 2 clients. The entire business ran through the husband, and just also at that size and scale, it's just not really much. It's hard to transact that. And I felt so bad that this broker had basically lied to them to get the listing and had not really prepared them at all for the reality. And so my friend Chris, who I've been friends with for 20 years, sat there for 3 hours and talked to them about how investors view a business versus how you personally view your business. And we talk about this, and it's funny, it's a restoration company. So we talk about this perspective that we have, which is just like a house, there's a known trade range for any business. Just like there's a known trade range for any piece of real estate, depending on where you are. And by the way, we got to live in reality. We can't pretend that our house in Kansas City is worth the same as a house in Aspen.
Right.
And the things about a piece of real estate, right, we know that drive value, like location, quality of the foundation, age of the roof, appliances, HVAC, paint.
Right.
These things matter, right? In a business, it's really the same thing but it's key man risk, succession, client concentration, operational leakage, financial performance. These types of things determine within a trade range and size the valuation of a business. But different than selling a piece of real estate, these things, all the how you've done these things to your business also will determine your deal structure. Right? Are you going to have an earnout? Are you going to have seller financing? Are you going to have rollover equity? Do you want to sell and retire? Right? These types of things. And so I spent a number of years when we started Samson, it was to bring all of this experience and knowledge back to founders, to basically same way that our personal injury clients are balancing the power against insurance companies on behalf of victims. I wanted to make sure that founders were never victimized to the extent that we could control it. And that if they ever thought about, whether they do it or not, selling their business at some point in time, maybe someday, to someone other than their children or their employees, to teach them the investor view, to shift their perspective, to make the business transactable, to make it saleable. But they don't have to do that. And I think we owe ourselves this duty anyway to our employees, to our families, because, if a lot of the business still runs through us, what if something happens to us? What's going to happen to our families, to their children, to our employees, right? So no matter what, taking this view from my perspective makes a business anti-fragile, makes it more resilient. And so I decided to devote this final chapter of my career to helping founders. So I know I've gone on too long, but
But you're providing them with an optionality that is different than the traditional option, because a lot of times personal injury firms, they sell out to the other partners, or a lot of times it is run by family members.
Correct.
It goes to the children, but this provides them an option, and also a capital option for their legacy heirs that they could
100%.
take advantage of as
But
well.
whether you decide to do this or not. And so we started to do this. I founded the company 5 years ago, and it was a year into that journey that we were contacted by a founder of a personal injury law firm that had a vision. And the vision was to acquire other personal injury law firms in other jurisdictions, and also to add onto that some other service lines, estate planning. Because if you think about it, many families, when they get this check, right, they're going to have to take care of someone, let's say, that's been critically injured for the rest of their life, So we want to make sure also that like we could help them be good financial stewards and like set up trusts and will. So like it's a kind of a natural cross.
It goes hand in hand because it ties in with the life care plans.
Yeah. And so we were retained by them to do this, but to achieve this vision was going to require outside capital. So I'd spent a lot of time in the CPA space, as I mentioned, in the dental space. And so we understood MSO structures, alternative structures from those markets. We studied the UK market, we studied the US market, we studied the Canadian market, the Australian market, and we also came to find out that MSOs had been used in legal in the United States since 2003, in Canada since 2001. But these really weren't discovered by outside investors. And so we went on a journey with them, a multi-year journey to enable this vision. And so we did the first private equity backed, institutionally backed MSO buy and build in these sectors in the United States and Canada over 4 years ago. And help them raise $150 million debt and equity, do their first acquisitions, build out their integration team, their leadership team. And that's how we developed our foundation here. As part of that, one of the maxims we have here at Samson is we don't do things that we've done. And so as a learning experience, I put myself in as the CEO of the U.S. business for a period of time, so that I could understand this. And I put my business partner, my co-founder, Jordan, who is now, operated and helped operate and streamline the operations at about 20 personal injury law firms since then to prepare them for exits. Part of our program, EVRS, Exit Value Realization System. She stepped in as the COO. And so we learned this from the inside out. So we are operators. We call ourselves arena dwellers, right? I've run, bought, build, sold, exited. My team has worked with over 200 private equity sponsors, and we were one of the creators of this category. At the time that we were doing that, VSS, and this is public knowledge, VSS was doing their first deal in a sector called creditors' rights with S&A out of Dallas, and Alpine was doing this in the corporate space with Briefly. And so we were some of the pioneers, which also led us to realize that this takes a community, because when you do these things, you need legal ethicists, and you need specialized transaction attorneys, and you need, the financials are special, and then you get into disbursement financing and litigation financing. And I had also helped the guy who helped us set up our structure in the U.S. was also the second or third person in Arizona to get his ABS, and he wanted to go down this journey. He became a client, Andy Kovesic at Aprio, now Aprio Legal. So helped Andy prepare for his, and then create a marriage with Aprio, who's backed by Charles Bank, and now they are nationalizing that. And it's beautiful, like through that connection. And I've done a podcast with Andy and interviews with Andy. Andy's in our book, The Owner's Manual, and Andy is also a member of PILA, the Private Equity Legal Alliance, which we formed for the industry. It is a consortium of, there's my Sammy logo, but there's the PILA logo. So we formed the Private Equity Legal Alliance. It's just a consortium of like-minded people from across the industry, all of the subject matter experts from human capital, finance and accounting, doing QVs, ethics, insurance, because how we have to re-underwrite the insurance of these things. So Danny Hughes, who's like the leading, plaintiff's lawyer, underwriter, Trisha Rich, Josh Port, Holland and Knight, C-suite on the financial side, Chamberlain, Matt Schockman on the human capital side. Because as we do these things, so we take founder businesses through this, and we've been through this, and private equity through this. By the way, they've never done this before. No one's ever done this before. We have, from the inside out, and we've done it in other industries. But when you're doing this, there are no platform CFOs who have done buy and builds in the legal space, and the person and the private equity guys haven't done it in this space either, right? Yeah. Who's going to be the COO? Who's going to be the chief technology officer for this thing? Who's
all those considerations?
The CEO of governing a buy and build, these types of things. So we also, we kind of like everything we've designed is both for founders and for private equity, not only to make sure that we're preparing the founders and protecting them and making sure that they're prepared for private equity, that they have done the things to engineer the business or remodel the business ahead of a transaction so that they can get the proper valuation and deal structure. And then we are there to support them on the other side to make sure that the private equity guys honor their commitments and that this is done ethically, it's done operationally correct, that founders are treated with the right respect and partnership that they deserve. And so we think of this as arranging marriages and then being the marriage counselor on the other side.
That's outstanding. So let me ask you, how do you counsel law firm founders who are considering an exit strategy to help them prepare for sale by basically de-risking their business, scaling, increasing transferability, or maybe stated another way, if you had 12 to 24 months to come into my personal injury law firm and help me do a complete top to bottom remodel,
Yeah.
what would you focus on for maximum exposure and transferability?
Well, I'll say this, and let's stick within personal injury if we can, for the sake of this, because we have now worked in 10 sectors of legal. And so the guidance is different across. So let's just, for the sake of this conversation today, let's stick to personal injury. Here's what I'll tell you. So we have, well, the first thing we do anytime a founder calls us is we say, what's your why and what's your vision? Why are you considering doing this? Is it because, and listen, we don't judge the answer, okay? We just want to know. For many, it's because they've been getting bombarded, especially in the last 6 months, with people saying they want to buy their law firm. And this is like, they're waking up to this and they're like, holy smokes, what is going on? All these people want to buy my law firm. And then they go to their peer groups and they hear about valuations or deals that were done. They have imperfect information. And by the way, many of us have had, I call these the country club conversation, where you're golfing with someone who just told you he sold his HVAC business for $250 million or this, that, the other. You don't know the context, right? So in any case, we ask them their why. And listen, there's nothing wrong with, holy shit, like, I thought this thing was worth 1 times on a 5-year seller note earnout from my partners. And now, gee whiz, like, I could get 5 or 6 or 7 or whatever. Like, I got to listen to that. I didn't know this was a thing.
Okay, sure.
So some of them, are like, hey, I've been thinking about this for a long time and I've got some other buddies I'd like to acquire. Some of them are thinking, I've got a really good thing going here and I've got an opportunity to de novo expand into other states, or if I could just pour gasoline on this fire that I've built from a marketing and intake and AI perspective, but all that capital has got to come from me. If I had some outside money, man, what could I achieve, right? So we're always asking the why, number one. And number two, it's like, well, what do you want? Do you want to be a platform? Do you even know what that means? Do you know what that entails? Do you want to join someone else's consortium? Do you want to do this with a family office? Do you want to do this with private equity? Do you want to do this with what I call strategics, who are these ropes that are backed by lawyers, right? Like, have you thought about these things? And then we take them through, and then we also, in many cases, sometimes in PI, it's a single founder, sometimes it's 2, sometimes it's 3.
Right.
If it's more than one owner, are you all aligned?
Yeah.
Right? So we're searching for alignment. We're searching for vision.
You're also talking about like 2 different things here. You're talking about an individual founder, a group of founders to sell their firms. Then you're also talking about more of like a peer group roll up.
Possibly, because many of what's happening, because of this industry peer groups historically.
Yeah.
There's probably someone in their peer group that is contemplating a deal, has been given an offer, or has done a deal. And then those peer group members are saying to them, hey, come join us. And they're like, whoa, what's this all about? And then they're asking themselves, well, what do I want? Do I want to be a add-on to someone else's vision?
Yeah.
Right. Because this is a big thing for founders. By the way, I'm a founder, we're all founders.
Yeah.
I'm a boss is a really boom, like mind-blowing thing. So like your why has to be really important. By the way, do you want to sell and retire? right? Like, so all these
Or stay active, sure.
or stay
Okay.
active. And it's like, what do you want on the other side? What do you want your life to be like a year from now, 3 years from now, 5 years from now? Like, what is it? Like, all these things are important. Then we go into an assessment. By the way, it only takes us about 48 hours to do an assessment now of a firm. And we can tell them, hey, based on what I'm looking at today, it's kind of like doing it like we're like the real estate appraisers. I keep going back to this analogy. So like we can show up, and if you got good data, we can understand your firm and your readiness, and we can tell you if you were to do a transaction today, especially in PI, because we've done this more than anyone, we can tell you exactly what that offer would look like, both from a valuation and deal structure perspective. We can also tell you, based on who's going to show up to the table, what the terms and conditions are going to be like, and whether or not you're going to have to face, depending on who the buyer is in your jurisdiction, if you're going to have something called a put right, which I don't really want to get too deep into, but it's a risk management feature of these deals. Like, so the headline price, and then the other thing, and so we can tell you this, and then we can say also, hey, just like remodeling a house before a sale, if you did these things in this order, which it'd be this amount of time, this amount of cost, I think this would be the variance in sell today versus sell 6 months or 8 months or a year from now, if you actually instituted these changes. And then it's a time value equation, right, for founders. And so we're able to do that within about 48 hours, especially in PI, because PI firms are businesses and that happen to produce legal services. And then the final question that we explain to people is, listen, the personal injury segment in the United States is a $50 billion or $55 billion market comprised of 50,000 personal injury law firms. And there are 6,000 private equity groups in the United States. And currently there are about 30 of them that are investing in or wanting to invest into the personal injury segment. Okay. And so just like a marriage, which these all are, it's not a transaction, it's a marriage. Like what types of people do you want to work with? And we also teach founders to ask the folks coming in, hey, what's your track record in, because we consider this a technology-enabled, marketing-driven, service. Hello. We consider this a professional service in essence, right? Technology-enabled, marketing-enabled, consumer-driven professional service. Hey, investor, what's your history of doing this in adjacent sectors that look like this? What did you do before? What types of returns on rollover equity did you produce, right? Can we speak to the other founders that you partnered with? Can we verify, right? You would do this kind of with a spouse, right? What kind of spouse are you? How are you going to treat me? There's everything you can tell me because, we're just getting to know each other. So you're not going to fart or pick your nose or do all these other things, right? The first time. And by the way, the seller's going to do the same thing. They're going to be very buttoned up.
Sure.
So we might want to get to know their friends. We might want to get to know the people that they went to grade school with or college with. We might want to get to know their parents, right? We need to really come to understand who they are as people, as operators, and as partners. And so, we really, and listen, like, it's not that it's okay to do a proprietary deal, but what's really important is you've built this business maybe over 5, 10, 20, 30 years. You might be second generation, whatever it is, you're going to do this once, right? And so in essence, it is going to be, to a certain extent, an arranged marriage, but you owe it to yourself to at least do some dating. And so this is the whole alchemy of this. What's amazing is that this option now exists. It's real. It's here. It's durable. And it's not for everyone. We write about this in our first white paper on this sector. We published a 60-page white paper to help founders understand this and give them context. It's also written for investors so that investors understand how to understand, because many of them are just looking at the segment for the first time. So we wrote this from our years of experience in operating space to decode this for everyone. We also codify this entire process in our book, The Owner's Manual, which is written for all founders of any business that are thinking about one day selling to a third party. So we've provided all this doctrine. And so, the dating and the courtship process is really important. Understanding your why is very important. But it's really, really cool, I think, for founders that this is now an option. And we cite this in the paper. Here we are 25 years into what was called the DSO, Dental Service Organization structure, which allows, dentists to sell, in essence, same way here, sell the back office to do a transaction, but it creates the separation, right, between the back office, the managed service organization, and the dental practice. Dentists still own the dental practice. MSO is separate. MSO can't tell the dentist, hey,
when to pull a tooth and when to give a filling.
Exactly, right. So here we are now 26 years into that industry. 15% of dental practice owners have decided to partner with private equity. 85% have not. There's no right or wrong. It's just a choice.
I was going to ask you if you envision the legal industry and the peer group roll-up almost being the equivalent as to what H&R Block is to tax or Aspen Dental is to dental. I mean, do you see enterprises and organizations like that going forward? There are roll-ups.
But I would say two variants, Kevin, of that equation. Let me explain. There are very few national personal injury law firms in this market, right? So we can name one, Morgan and Morgan, right?
Right.
By the way, we think that they might have, I don't know, 2-3% of the total market, as big as they are.
Mm-hmm.
There's another one, Sweet James, who's a regional becoming a national brand.
Right.
So when you think about H&R Block, we think of that as a national brand that was really built de novo, right? Right. It's a ubiquitous brand. Aspen Dental, right, or Heartland Dental, when they've acquired other practices, they've integrated the brands. That's called right a single brand strategy. There's another strategy, and we teach this and we have an M&A class that we teach. That's called a house of brands. And so let's think about, for example, because I use this example when I'm talking about the durability of these brands and NIL, name, image, and likeness, in many of these brands. Let's think about the group that owns both Taco Bell, Kentucky Fried Chicken, et cetera, right? Or let's I'm trying to remember off the top of my head.
It's
Pepsi. It's Pepsi now. Thank you, Pepsi now.
PepsiCo, and it's Pizza Hut as well. Yeah.
Right. But even Pepsi has multiple brands, right? Coca-Cola, the holding company, right?
Oh, it's not. Yeah, I tell people this all the time. It's not just a beverage company. There are verticals of products all across the grocery store that Coca-Cola, Pepsi,
Right.
Nestle all produce. Yeah.
Yeah. And so so we've seen this in a number of other sectors where we call it a house of brands. House of brands, right? As opposed to a branded house. House of brands, branded house, right? Even like in luxury goods, right? So like now Louis Vuitton owns, right? They own multiple brands. They haven't done a brand consolidation there because each of these brands, especially in consumer services, hyper local consumer services, these brands have existed for a long, long time. But to your point, will we see more nationalized personal injury? Yes. However, my opinion, for the most part, is that is going to be a house of brands, because I might go acquire someone in Kansas City, and then I might acquire someone in Indianapolis, and I might acquire someone in Columbus, Ohio, and I might acquire someone in Detroit, and I might acquire someone in Louisville, Kentucky, and I might acquire someone in Pittsburgh to create a regional holding company of brands. But that firm in Columbus versus Indianapolis, let's say that brand has existed for 10, 20 years. And I ask investors all the time who are thinking about this first, said, where do you live? Now name me, sing me the jingle, or name me the person. Why on earth would you change that brand? that is how you destroy value. Now, what we might do on the back end is say, hey, we're spending a lot of money on digital advertising. Might we all pool that, right, to get better leverage and return? Hey, what are you doing on digital that I'm not doing? What are you doing in these marketing channels that I'm not doing? Hey, what are you doing on intake that is providing a higher conversion rate? Hey, how are you managing your MVAs or your workers' comp cases or your nursing home abuse cases? How are you working that map?
It's the best practices from each
Yes,
individual entity
yes.
to
And so,
create
what
a
we can
nationwide.
do, yes, so we can learn
Yeah.
together, we can optimize these things, we can grow together, which then drives synergy and growth for all the players. Now, that's not to say that there won't be instances where, let's say there's a brand in, I'm in Houston today. There's a brand in Houston. It's a really strong brand. And by the way, maybe it's a settlement referral shop. And we decide we want to vertically integrate into lit, and the people that we've been referring our lit cases to, we want them to join us, but they're not really branded, right? So I'm going to absorb them, and they're going to become our branded litigation department. I'm in Austin, and I'm really big there, but there's this other brand that I'm going to acquire. Then it becomes an interesting conversation. Do I want two brands in that market, or do I want to integrate? There's no right or wrong. There's no right or wrong, because, by the way, maybe two brands works, and maybe those two brands cater to different ethnic populations. For example, I might enter a market like Orlando or Phoenix, and I might have my brand and marketing channel that's going after catastrophic semi cases.
Sure.
I'd also have a brand that's going after run-of-the-mill MVAs with Gen
Falls.
Xers. I might also in that market decide I want to buy a firm that's an abogado firm and is catering to the Hispanic market. And it might make sense for me to own all three of these kind of sub-brands. It might make sense over time. But the durability of brands, when we take a look at the valuation of these firms, so I think what we're going to see more of here is what we've seen in residential home services, is what we've seen in also commercial HVAC, quite a lot. Where again, like in residential home services, think about it like where Kevin, you're in Cleveland. By the way, I am on the board of the Smith and Obie company in Cleveland.
Okay.
I'm on
Nice.
the board I'm a proud board member of the Smith and Obie company. We are acquiring other firms in other cities and Smith and Obie has been around for decades. It is well known to all the contractors in that town. Now, we have a holding company that owns all of these brands. The holding company is called Foundrel, built for founders. Right. So the holding company is called Foundrel. As we acquire, firms in Detroit and, Indianapolis and Columbus and Cincinnati, those firms have an established name with right, the contractors, with the building owners, with the facilities managers, with the procurement teams, right? All these things, very, very well-known brands. Now, would it make sense for me to say to them, you know what, I'm going to rename everyone Smith and Obie, or I'm going to rename everyone Foundrel? Like, that might just cause confusion. Like, wait, what? Huh?
But it's diluting the other existing brand names that are in the house of brands.
Yeah. And if you take a look at like Comfort Systems, who's the most successful, the guy who trained me to do what I do, Alan Crucy, who was my mentor at AECOM, where I started my career in professional services a long time ago, in architecture, engineering, so another, technical professional service. Alan was the head of M&A there. And for a long time, AECOM very, very successfully just operated under all the legacy brands. Over time, what they did was they did a sub-brand called an AECOM company, because what this meant was we could bring that meant something because we had acquired all the best technical subject matter experts from around the country.
Mm-hmm.
And so if you were looking at a bridge project or a highway project or an industrial project, we were not only through that local brand going to be able to bring you our talent from there, we were going to be able to bring our talent network for complex infrastructure, complex industrial projects from around the world. Right. And so Comfort Systems is a great emulator of that. They're the most successful in the HVAC space, publicly traded. The stock, Alan's was a board member there for 20 years. So I learned a lot of this from Alan. And so, they when they first started, they kept all the individual brands. Now it is brand a Comfort Systems company because that means something. This means, especially, but in that sector, it also means something which is different than in personal injury. Because if you are a portfolio manager of national real estate, you know that any company that Comfort Systems owns in any other market, if you had been buying HVAC services in Columbus and Cleveland and Cincinnati and Louisville, and then let's say you just developed a property in Orlando, you know that if Comfort Systems owns a local provider there, you know that it stands for quality. You can get consistent service, right, nationally, right? However, personal injury, we don't have these same migratory. We're not selling to multi-state portfolios, right? We're selling into a local. I've gone on too long about this, but just trying to right.
Yeah.
So this is how I believe the space. But it's not to say that we won't see national brands emerge. But I think what you're going to see in the early evolutions of this is rule number one: do no harm. Do not
Yeah.
fuck up a good thing. Rule number two: USA, not patriotic. It comes from the ITW business system. I started my career in manufacturing.
Mm-hmm.
Understand, simplify, then automate or take action. Go understand the company you bought. You can only know so much in the diligence and the courtship process. Come to understand the unique characteristics, especially in personal injury. What I say, it's like these firms are like snowflakes.
Mm-hmm.
All look the same from far away, but you get close up, and how each one of them has both their brand and their operational infrastructure highly unique. So come to understand it. Then, as you start to work with those partners that you've acquired, ask your partner, or hey, partner, tell your private equity partner, here are the things that I would like to fix or enhance that are on my short list that I have not been able to get to, or I don't have the capital to do. And do those things that simplify work, make life easier for everyone, create the enhancement that the founder has been desiring that they couldn't get to themselves. What this does is it builds trust, right? And then we can start to take bigger, bolder actions. But do no harm. Take time to understand the first things you do. We want to simplify work or make things easy, unlock the things that they could not do themselves. Slow is smooth, smooth is fast. Then as we develop this trust as an organization with our new partner, both for the founders and the employees, right, then we can accelerate the pace of change to grow profitably together.
I think that's great. I want to talk about automation and how automation can actually increase margin value and saleability. But first, let's back up a little bit. Just for the people who are listening and are being educated to this for the first time, I'd like to talk about like the market space, and then what makes a personal injury law firm attractive or raises red flags, and then go into sort of the automation around how that you can increase value. So you had mentioned there's about 50,000.
Where do you want to start? Sorry.
We're going to start. I'm going to back up.
Simple-minded overachiever here. I speak. Yeah. Sorry, Kevin.
I know I think we both have a little ADHD.
Oh yeah.
I want to start with the market. And so you had mentioned that there's roughly about 50,000 personal injury law firms in the country. They really range in quality and caliber, from a 1-star to a 5-star.
Just like any industry.
Yeah, I know. So, How many of that 50,000 do you really think are scalable and sellable? I just want to sort of let the market know, like out of this 50,000,
Well, it's also, yeah, and it's an important.
how many do you think are actually given?
There's today and there's a year from now. Okay, so I have to. So right now, if I were to just say empirically, without knowing where a founder is in his or her vision,
Like the percentage across the market?
I would say that right now, to be transactable, ready for a transaction, fine. Just say looking. If I just look at the numbers,
Strength, operations,
just
marketing,
all
program,
that,
everything.
and size matters
Size,
because
potential to scale.
even though you might want this, if you're like 2 million of EBITDA, they're not coming for you yet, right? They're not ready for you yet. So
Yeah.
if I say firms that are 7.5 million of EBITDA and above that are well run, dialed in, and by the way, the range, we're seeing firms transact right now from 7.5 million all the way up to 70 million of EBITDA. Okay,
Hmm.
the range we're seeing, right? I'm guessing that there are just about 1,500 to 2,000 firms of the 50,000
Yeah.
that are transactable. If I just look at it through the single lens of good firm, right size, dialed in marketing operation, whatever, whether they're a settlement referral shop, a lit shop, a hybrid shop, whatever.
Yeah.
But 1,500 to 2,000 are transactable.
I would agree with you. I did some research internally because as part of Certain Group, we have our own MSO and we're in the business of buying law firms, which we're working with you on as well. But
I'm aware of that.
I used a I used
Heard
a
of you
bunch of
guys.
I used a bunch of proprietary programs and triangulated some information, whether it was like Zoom or Bloomberg or Lexis and Westlaw and all these, and I looked for firms that
You
generate.
guys are very sophisticated. By the way, like you guys are way ahead of the game in
Well,
terms of your data analytics and
my background's in legal. I did legal technology sales for 15 years after being a criminal defense lawyer and before getting into litigation funding. So it's sort of in my blood. I helped build out some of the proprietary systems that some of the major providers actually use. But
super cool.
my research showed that between firms between like 30 and 30 million in EBITDA came up with like 780 firms.
That is.
Sounds about right.
So we basically say
Yeah.
in our estimation, and this is without the data. This is just
So
me.
that's the pool.
This is with
Yeah.
me just living in the world and knowing what I know. I tell people in my estimation there are 750 firms that are 25 million of net income and above that are well-run personal injury firms that are owned by 1 to 3 people. And the other thing is like the less owners, the more private equity likes them because now we're negotiating with one person, not 3 people with different timelines and agendas.
Yeah. So okay. So hone down into the and into this and see what the market actually bears. So 50,000, 1,500 are probably scalable and sellable. That would be attractive to personal injury. Do you have data like how many private equity acquisitions occurred and you made a big point about this year versus next year and it's a huge difference. Like how many occurred, let's say in 24, 25? How many do you think will occur in 20?
With outside cap within PI it's complicated,
And
right?
what do you think? I'm just trying to get your opinion on like the growth trajectory of
Yeah, so it's
buying.
complicated definitionally. So
Okay.
let me caveat this. And by the way, like I will provide you my opinion, and I know how many we did, and then I'm aware of some of the others, right? And here's the thing that's important for people to understand is that private equity is a broad term. If you lend your son or daughter some money to start a business, you're a private equity sponsor. Okay.
Sure.
If you take venture, whatever. Okay. Now, in this industry, there have been lawyers buying up personal injury law firms for some time. And so, there's one out of Puerto Rico, there's one out of California, there are 2 out of California that have been doing this. So So I don't consider that. Now, I do consider that technically private equity, but that those are industry insiders who are lawyers playing the private equity game, right? So this has been
Right.
going. This has been going. So like you say, like okay, well in 24, the strategics, and then there was us back then, right, and just a handful of others. But like, how many transactions might have occurred across that diaspora? Let's say 20. But let's say 15 of those were industry insiders that have been doing this for a long time, still lawyer to lawyer transactions. Maybe in 24, 5 of those deals were what we would consider institutional or non-lawyer private equity within PI, right? So like now let's say go to 25, and that same volume that was occurring in the traditional sector was still happening, although the competition changed. So private equity hadn't discovered the market before. So it's kind of like when I was buying homes with my brother-in-law in Columbus post Great Recession.
Mm-hmm.
I was picking up single family homes for between $25,000 and $75,000. Now, what happened? What happened in the single family home market a few years post Great Recession? Blackstone and Carlyle and all these guys formed REITs to
Yeah.
acquire, right, to acquire single family homes in
Portfolios.
portfolios, right? So they became some of the largest owners of single family home properties. So the competition, like, so what started to happen is I started to get outbid. I stopped buying because they were driving up the market, right?
Mm-hmm.
And so this is what is so this is part of what's happening. And so like so this shifting is happening, but I would say like, last year within PI, maybe there were 10 PI deals bought by outside non-lawyer institutional private equity.
So about 1% of
And
those
still,
firms, I
but
think, are
still like
selling.
maybe like still 15 were done by the others.
Mm-hmm.
This year, right? What I will anticipate is that with the combination now of lawyer backed, mass tort backed, lit finance, the strategics,
Right.
the way the litigation financiers also do this and have been doing this for a long time with minority stakes,
Mm-hmm.
right? So that's been going on for a long time, right? So not majority recaps like everyone just read about the Rafi deal, which was a minority deal,
That
right?
was huge.
That's been going on for a long time, and
Yeah.
it's complicated. But anyway, so what my anticipation is that with NPI this year, across the diaspora in the United States, there will be 40 to 50 transactions.
So 100% increase over the last year or so.
Yeah.
So it's yeah, and then we can assume the same trajectory. The following.
There will be another doubling next
See,
year.
that's yeah.
Next year, I anticipate 70 to 80 transactions.
Yeah, so 75 to 100% growth year over year, which is
Yeah, and then it'll kind of stabilize. And then what happens is after all the and to buy down the multiple, once they've established these beachheads. So a lot of what happens right now is when a market is this big, Kevin,
mm-hmm.
when there are that many firms above 25 million, or then you say how many firms are there that are above 15 million of net income that are owned by single founders. Now we're probably doubling the number you said before, so maybe now we've got 2,000 to 1,500 targets. Well, we're like doing this
Yeah.
is hard. Doing this is hard, right? Founder transitions are hard. Deciding that you want to do this, convincing a founder to come to you because there are 30 active bidders in the market for this. How does a founder make a decision on who they want to work with? But it's to say that as a private as the person who's also on the private equity side, right? It's like I could go buy one firm, right? That's 15 million of EBITDA, or 3 that are 5. Now I might be able to get the 3 that are 5 million for like a little bit cheaper, but the transaction costs, the friction, all the emotional, all the change management. So what we typically see happening at the earliest stages of this is that it's the larger firms that go first. We're also typically paying more for those. In the second, then we have to optimize and kind of like a boa constrictor, digest what we've eaten. We got to make sure that we're doing a good job. We've honored our commitment. We're enhancing technology. We're enhancing the marketing. We're keeping everyone happy. We're spending a lot of time USAing and making sure that everyone's not afraid of the big bad outside capital wolf, and that there's plenty of job opportunity and growth. There's this whole emotional support, that has to happen, right? And so, like, think about having to do that at 3 small acquisitions versus the intention and the effort.
It's the same amount of work.
The same amount of work.
One transaction at 15 or 25.
And it's kind of like in PI, we can understand this, right? Do I want to take on 3 dog bites or one truck accident?
It's the same thing with litigation finance or litigation insurance. If you want to finance your insurance deal for 1 million or 10 million,
right,
the same amount of legal work and integrity has to go into the $1 million deal versus the deal that is a $10 million premium.
Right.
It's the same work, it's the same underwriting, it's the same due diligence.
That's right. And so over time, though, what we might do in those jurisdictions where we've acquired, the big boy, and as we start to show who we are, enhance marketing, enhance intake, enhance technology, become the best place to work, take more share. Some of the smaller guys are going to be like, do I want to join forces? And so, you'll see that second wave. And if we model what happened in the UK, different market, different economics, it's a more socialized system, all that other stuff, but post deregulation in the UK market of the legal industry, the personal injury space, for a period of about 7 to 10 years, went from 200 personal injury law firms to 20. That's how. Now, this is a much bigger market. The economics here are much different, right? We're not going to see that type of consolidation, but here's what I will guarantee you. 7 to 10 years from now, there will be 5 to 7 of these holding companies that are the size of Morgan and Morgan. I guarantee it.
Yeah, that's a fascinating.
But even if that happens, if we assume that Morgan and Morgan, and Kevin, you have the stats, can we say is it okay if I cuss?
Sure.
If we can say for shits and giggles that they have 3% of the U.S. market.
Higher personal injury, U.S. catastrophic.
Let's just say that's the case. Okay.
Sure.
And let's say that I'm breaking out my calculator because I can't do it anyway. Let's say that there are 5 more Morgan and Morgans 10 years from now. Let's just say that that's the case. Okay. So, and let's just say each of them at that point in time have 3%. So that'd be 6 of them.
Almost 20% of the entire market.
About 18%. So here we are 10 years later. We're kind of where the dental service market was.
Yeah. 5 or 6 firms.
There will be other roll-ups.
Yeah.
There will be other roll-ups as well. Let's say there's another 5% of the market that's consolidated 10 years from now. That means that we could see, let's say 10 years from now, 25% of the market, being institutionally backed and 75% not. And
okay.
I don't know. That's probably how I see this playing. Now, could it be faster or slower? I don't know. But you can only go so fast. These are marriages. These are transformations. We got to, and not everyone's going to want this, right?
Maybe it's 7 to 10 in any way in about the next decade or so, give or take.
Let's just say 20 to 25% of the market is that, and 80% is not.
Okay, so we know the direction.
Then that's just in PI.
That's just in PI. And your prediction based upon your experience, which is more vast than almost any other player in this entire market. So the number of firms that are sellable or scalable right now is about 1,500 out of 50,000. It's going to grow. The beachheads are going to be established. This is going to get media attention. Yeah. People are going to start paying attention to this, just like
they are.
They did litigate. What is litigation finance 10 years ago? What is litigation insurance? What is an MSO? What is an ABS?
Yeah, and the problem is, gosh, there's so much education, man. Oh, Kevin.
Well, yes, it's a total evangelizing.
I need to be able to spend more time teaching
Yeah.
It's why I published the books, the white papers. I'm coming out with another book.
Well, we had mentioned doing a city tour of the owner's manual founder's city
I
tour.
really want to do it. I teach
And
classes for free all around the country.
yeah, and going
I
around
just
doing
did
it.
one for like an electrical contractor assistant. Like, it's really important that founders understand what this is, what it isn't, what the option is, how to think about it, right? Um, and 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 it's just the other thing that's really important that founders are sharing. I write about this in the book, and in the white paper.
Yeah.
When private equity decides, here's the thing, and I see this happening in corporate law. I've been writing a lot about this now, and I'll explain this in two ways. Number one, when private equity comes into any industry, let's go. I'm going to make an analogy to marketing-driven consumer services, but HVAC, residential HVAC. Private equity comes in, they buy your firm, they're going to say, okay, guess what? We think that you can take more market share. You need more marketing. So we're going to spend more money. And by the way, we think that we can optimize routing and we can also optimize procurement because as we grow and as we acquire more firms nationally, guess what? We can get better purchasing agreements with HVAC equipment distributors, right? So we can get better leverage, right? So, no, this also happened in dental, right? Dental, what happens? Come in, take Aspen, right? That's now this national brand. They're enhancing marketing. By the way, intake, all these things. By the way, the big expense line in a dental organization is imaging equipment, medical supplies. Think of all the durables that are consumed in that practice. Now, if I own 1,000 practices versus one, guess what? I get procurement leverage, right? Which means that I can enhance my profit. I could drop my price. I could increase my whatever I want to do. But I get procurement leverage that then allows me to spend more on technology, more on brand. I can now spend more on recruiting. I can now pay so when private equity enters a market in mass, it means that the industry dynamics will shift. So you cannot ignore it. If you choose not to do it, that's fine. But just know that like CAC in a market might go up. So what do you have to do? You got to figure out, all right, like how do I compete with that? Do I need to go branded, non-branded? Do I need to acquire non-brand leads? What do I need to do with intake if I'm going to bifurcate from branded to non-branded intake? Right? What am I doing? How am I screening my cases? How am I working matters, right? To get higher average cost, higher average, settlement values. How am I using technology to become, more efficient? And a lot of PI guys already run their business this way. But if private equity enters your market, and many of them have already seen it through ABSs, right? Entering their markets, et cetera, the competitive dynamics change. And so no matter what, you cannot ignore it. You must compete with it.
I think you're absolutely right. And I think that's very, very insightful. So, we are getting close to an hour.
Oh my gosh.
And I try to wrap these up in about an hour. So let me ask you a final question. In my usual fashion, it's going to have three parts.
Oh, shit.
The market is expanding. More people are going to want to get into this space. So if you had to say top three things a firm should do to make themselves sellable, they should start focusing on today, and top three red flags which make a firm unsellable that you should avoid, what would
Sure.
you say those are?
So many of the scaled firms have already done this, but reducing key man dependency, right? So especially if you want to sell and retire, if that is your objective, or sell and take a back seat, start really grooming someone to be the CEO, right? And that's really important. But the leadership stack, the development of your team, the leadership stack matters. In many cases in these businesses, right, there's not like client concentration, but I'm going to get to that in a second.
Okay.
Right. I can get to that in a second. But I would say, really fortify and spread out and start, EOSing yourself, right? Like remove the dependency on the business on you. Don't worry about the NIL, but operate like this is number one. Number two, revenue durability, revenue mix. This is very, very important, right? The ones that are getting the highest valuations right now are the ones that have consistent durability of brand. Signups, right, are exceeding settlements. CAC is stable, right? If technology is being implemented, average settlement values year over year are going up because you're proving that you actually know how to work matters and have leverage against the insurance companies, and that the revenue and profit is really spread across a large portfolio. Do not do this. We see this in many industries, and the investors will catch you. You have this 1 year, and you had this big old case, and it's never happened before. You have this big spike, and you're like, hey, look what I just did. I'm going to go sell on a high. Boom, boom, boom. And guess what? Carve that out. And then you're going to be like, well, no, look at my case inventory. It's there. And I don't know which one, and I don't know when, but come on, give me. Well, listen, now different. If year after year after year after year after year, for the last 5 to 7 years, every year, your sine wave looks like this, and you can prove from your case inventory and how you work cases, et cetera, that, hey, you don't know which one, but every single year,
One spike doesn't make
there
it.
There were 5, then there were 6, then there were 7, then there were 8, right? And your brand attracts those and all this other stuff, but that big spike, watch out, like don't kid yourselves.
Of course, makes sense.
And then I would say that, you know, number 3 is very few founders in this industry understand the view of their financials through the investor lens. Now, this is the case in almost every single founder-led business. And I joke, a gap is not a space between your teeth. It is an accounting method that outside investors and lenders use. What I want anyone that's thinking about this to do is the following. That will not cost you much. Hire someone to restate your financials through the private equity lens. Understand how your cash-based net income optimized for your personal wealth and tax preservation financial statements convert to the investor view, so that you're not going into a conversation thinking that your tax optimized cash basis net income is EBITDA. These are 2 different things.
Good point.
You must understand you must live in reality, and I do not want you to be surprised. I'm not telling you to change how you are running your business operationally and financially. I am telling you to go get someone to show you how your business would look through this lens.
Which is different.
And what I want you to do, if you're thinking about doing this, I want you to run almost 2 sets of books, is how you're running it today. And I want you to side by side have the conversion of that, right, to the investor view.
Yeah, good point.
Hey, you can start to think about, it's one thing about you will not be caught off guard, and you are, and basically in essence, when you then, if and then you decide to go to market, you have completely de-risked and taken out the risk equation of, is this deal going to hold? Is this deal going to break? Are they going to say, hey, you've been doing this and that, start futzing around with your numbers? You've basically private equity enhanced yourself. And by the way, this is not just for PI. These are the maxims that we teach founders of every business, any business. If you are one day contemplating this, I have decoded for you exactly what's going to happen. And by the way, you don't need our help. Just read the book.
Okay. All right. Red flag. Red flags are things businesses should avoid. I guess it's basically just
Oh,
the
listen,
antithesis of what you just said.
listen.
Don't be
There are a lot of things,
centric.
but I would just say, like,
Don't
look, like,
incorporate technology.
well, here's a thing that, like,
Not using AI.
here's a big thing. Both customer, but employee NPS.
Mm.
So listen, all PI firms are tracking their Google ads and all that other stuff, but one of the ways that we look at the quality of a firm is through voluntary and involuntary attrition, right? Like,
Sure.
it's a really good measure of, are your
That's
people
true.
happy? Like, how long have they been there? Your source of hiring, how much of that is through outside recruiters or through referrals, right?
Personal.
I'm sitting here in an office today, and I just wrote a letter to some folks, and I commented on just how welcomed I was.
Yeah.
How everyone's smiling, everyone's got pictures of their kids and their families at their desks. Like, this is a really happy,
Would you say it's a business is almost like a good marriage?
yeah. And like, and also, like, hey, like, have you had a bunch of pending litigation against you? Have clients sued you? Have employees sued you? Have vendors sued you? Right? Like, so here's the thing.
It's a good benchmark.
There's a lot of choice in that. I just said, right, like, these are the other things, right, that investors are going to look for, because there are a lot of firms that look the same way. The question is, same way you're vetting them, they're going to be vetting you.
Yeah.
Right. And so these are some of the intangibles, so that's kind of like, if you have been sued, or whatever, these are just things you need to be cognizant of. Like, do you pass the morality test?
Yeah. Internal friction with your current employees and clients.
In essence, right? So,
Yeah.
and then I think, like, really understand, if understand your channels, understand your conversion by channel, understand understand your CAC, and these types of things, and your conversion rates, to really understand your operating. And many of you belong to peer groups and all this stuff, and you're tracking this stuff. So there, I would just say it's like, it's those types of things. But here's the biggest thing: do not engage in these I know y'all are getting called every day. I know you're curious.
Mm-hmm.
You really have to understand your why. I started with this, and I will end with this.
Okay.
Right? Know what you want. Know what type of partner you want. Go through the emotional journey yourself of almost pre-grieving the fact that if you're choosing to do this, you are going to have a boss for maybe the first time in your life, right? And you're going down this journey because of a threat to you in your market, or the opportunity in front of, whatever it is. But, like, it's really important that you know what you want, and if there are multiple partners involved, that you all are aligned. Because if you're not, this shows up in diligence, right? And these are the emotional things, both misalignment. So even if it's us, the internal, we don't understand ourselves. And listen, if through the process, right, you end up saying, this is not for me, that's okay. But I need you to know this. Certainly, if you have marketed your business, right, gone to market, whatever, everyone, you send out you hired a banker, blah, 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 blah. And the deal breaks, even if because you decide to break it because you're just not ready, you are dead in the water for 3 years, because no one will know the truth, and they'll make up their own narrative, and everyone will assume something's wrong with your business, and you're untouchable for a period of time. So you better have your internal stuff together.
Ready to go.
Don't know what,
and know your why.
yes, if you don't know what you want, wait till
Don't.
you.
Excellent point, and I think a fantastic note to end this program on. Seth, thank you so much for just all these incredible insights on the world of M&A and personal injury firms. It's been extremely valuable, and I think it's top of mind of many people. And I think this show is going to attract a lot of attention.
Yeah, and look, we'll come talk to any group. I'll come teach anywhere. I'm speaking in Chicago tomorrow. I'm speaking in Puerto Rico next week. I'm
Okay.
speaking and teaching in San Antonio at the end of the month. I'm teaching in Seattle, more for corporate law firms at the end of May. I said the end of the month. Well, that's all in May. I guess that's later this week.
Yeah.
I just taught a class at NYU. We teach classes to EO and ACG. Anyone that wants us to come, listen. All I ask is that I'm an entrepreneur. I'm a founder. Maybe pay for my plane ticket, but I'll probably pick that up myself. But
Sure.
all that I ask is that there are more than 10 people in the room, and that everyone has read our book and done some homework before I show up. So that
Sure.
when I walk into the room and we start teaching and workshopping, everyone can express their why. Whether they really know or not, all that I ask, if I'm going to come, I'm a founder of this business. I've got clients. I'm founding my third business associated with all this stuff right now. But I have all the time in the world for founders. All that I ask, I will come prepared. And I promise you this, I will be fully present and there for you, all of me.
Mhm.
All that I ask is that you do a little bit of homework before I show up.
I think that's a fair trade. Now, if anybody would like to get a hold of you to discuss any of the things that we covered here today
Sure.
and more, what would be the best way to reach you, and what are all your handles?
Email my assistant. You can
Okay.
copy me. Nadia
Okay.
controls my schedule. Nadia at samsonpartnersgroup.com. My email is Seth at samsonpartnersgroup.com. Our website, which I believe will be scrolling here, is samsonpartnersgroup.com. And it is the biblical Samson, not the adjusted with a P. I just bought those domains because people, I get it. There's Samson and there's Samson. We are SAMSON, the biblical Samson. Our book can be found both on our website and on Amazon. Here's my Coach Deutsch sweatshirt. The Owner's Manual, Why, How, and When to Sell Your Business Private Equity. We're going to probably rename this because it's more take the investor view and have optionality. If at some point in time, this is not a good working marketing title. If at some point in time you think you might, learn to fortify your business and be prepared. But the book is available on Amazon. Our white paper on the personal injury sector, 60-page white paper that was created by Peel, is on our website, Holland & Knight's website. By the way, I think next week we're putting out our second white paper. I think next month we're putting out our third. I'm trying really hard, folks, to help you all the best I can while doing all this stuff, because founders deserve it. So samsonpartnersgroup.com, Nadia at Samson Part. And I mean, I'm not going to give you my cell phone, but we do actually do billboards and commercials.
Okay. And we will feature the commercial links
Yes, we'll get those to you. And
on recordings of this
I
podcast.
do have a vanity number. 1-866 Sammy wins.
There we go. All right, Seth, truly fantastic, phenomenal discussion. Thank you so much for your time.
It's my pleasure. Thanks for having me.
And of course, I'd like to thank our huge audience for listening. If you'd like to listen to this broadcast or any of our other episodes of Alternative Litigation Strategies, it is available on Certum Group's website, certumgroup.com, one word, and we will be featuring this on LinkedIn, X,
Let's go.
Apple, Twitter, Spotify, Stitcher, and YouTube. So you can find us anywhere you listen to your favorite recordings, and this definitely should be one of them.
I got to add one more thing. I did do a podcast. It was funny. It's called Diners and Deals. It's on Spotify. You can listen to that. And if you want to meet with me in person, every day that I'm in Chicago, I am at S&G Diner at 3000 North Lincoln. And so
right.
That is the other place to find me. Any day I'm in Chicago, I'm there every single morning, and I take meetings in person.
Awesome. Thanks again, Seth. I appreciate your time. Looking forward to helping you schedule more of your owners and founders meetings.
Thank you.
So all the best.
Peace.
Bye now.